All right, let's dive right into the story of Take Solutions. This is a company in the middle of what it calls the Phoenix pivot, a massive high-stakes turnaround. And as you can see right here, the outlook is volatile. That's exactly why we're digging in, because this is a really compelling case study. And this slide, well, this slide captures the core conflict perfectly. You've got this incredible 600% stock rally off the lows on one hand, but on the other hand, the company is bringing in virtually zero revenue from its actual operations. This huge disconnect between the market's excitement and the fundamental reality is what we're going to unpack. So, what exactly is this Phoenix pivot? Take Solutions used to be a pretty big deal in life sciences IT, but back in 2021, they sold off their crown jewel, Navitas Life Sciences. That kicked off a really tough period of deleveraging. Now what's left, the new take, is betting the entire farm on a massive pivot into artificial intelligence. Now, if we look at the chart, the technical picture tells a story. The stock has been absolutely hammered for years, but look at the far right there. You can see a recent recovery, and it's happening on rising volumes, which is interesting. Still, it's trading way below its key long-term averages, so even with this momentum, you've got to be cautious. Okay, so that brings us to the bull case. What are the optimists seeing here? Well, the entire argument, pretty much all of it, hinges on the company successfully pulling off this pivot to an asset-light AI platform. It's a bet on a complete and total transformation. The story management is telling is a classic one, right? Get away from the old, struggling business and jump into a hot, high-growth sector. They're aiming squarely at India's massive $370 billion healthcare market with their one-minute clinic idea, shooting for what they're calling asset-light AI dominance. And here's the kicker. They aren't trying to build this whole thing from scratch. This slide shows their core strategy. They're plugging into powerful existing AI models from Anthropic. We're talking Claude AI and from OpenAI. That's the engine that's supposed to power their whole unified AI marketplace, which, by the way, lines up perfectly with the government's India AI mission. So if you're a bull, this is the path you're betting on. Step 1, they establish themselves as a player in a niche AI SaaS market. Step 2, they use that platform model to get really, really efficient with their operations. And step 3, if they can do all that and do it fast, they could become a very tasty acquisition target for a much larger healthcare company. That's the dream scenario. But of course, that's only half the story. Now we have to flip the coin and look at the bear case. And this argument is built on a foundation of, well, fundamental fragility. All that optimism about the AI pivot runs headfirst into some really serious financial risks. This chart right here highlights what is probably the biggest red flag of all, revenue quality. I mean, look at that. Core operations are generating next to nothing. The net profit they reported in Q3 of about 1.11 crores, that came almost entirely from other income, basically from selling off assets like Take consultancy services. It's profit, sure, but it's not coming from the actual business. Then you look at who owns the stock. It is completely dominated by retail investors, a staggering 94.8% of the shares. Institutional ownership, the big money, is almost non-existent. This makes the stock incredibly vulnerable to wild price swings and something called a liquidity trap. Basically, if everyone wants to sell, there might not be any big buyers around to soak up the shares without the price just collapsing. This slide really puts the pressure into perspective. The company is in a desperate race against time. They've got about 19.42 crores left in liquidity and tax credits. The big question is, can they start making real money from their AI platforms before that cash runs out, paying for things like statutory dues and old legal battles? The clock is absolutely ticking. And if all that wasn't enough, here's the real bombshell. In February of 2026, the company's own statutory auditors issued what's called a qualified opinion. In it, they flagged a material uncertainty about the company's ability to continue as a going concern. I mean, that is a direct warning from the auditors, questioning the very survival of the business. So you can see how the downside risks just cascade one into the next. It all starts with the zero operational revenue. That forces them to burn through their cash on things like litigation, and that in turn could lead to the whole AI-driven stock bubble just bursting. A failure to generate real cash flow is a straight line to insolvency risk. Okay, so when we put all these pieces together, the bull case and the bear case, what's the final verdict? We've got this high-potential AI story on one side, clashing with a really dire financial reality on the other. It's a classic textbook definition of high risk versus high reward. Ultimately, Take Solutions really fits the description of a speculative recovery play. And as this risk gauge shows, the needle is deep in the danger zone. While the returns have been huge for some people who got in at the bottom, this has all the classic signs of a value trap. It's fundamentally unsuitable for any conservative portfolio until we see consistent, real revenue coming from their operations. So, after looking at the bull case, which is built on this really promising AI pivot, and the bear case, which is grounded in some severe financial warnings, the central question we're left with is this: is what we're seeing a genuine business transformation, or is it just a high stakes survival tactic?